Welcome back, everyone. My name is Richard Engberg, and I'm an equity research analyst here at Erik Penser Bank with focus on tech. With me here, I have Peter Messner, CFO of Catena Media, and Michael Daly, CEO of Catena. Peter and Michael, the floor is yours.
Thank you very much, Richard. Good afternoon, and welcome to Catena Media and our little company presentation that is updated with just our quarterly results for the first quarter 2021 that we announced yesterday. We intend to guide you a little bit through what is Catena Media, a company introduction about the backgrounds of being an affiliate and what we essentially do. Michael, our CEO, will guide you through that and also talk a little bit about the highlights of the first quarter this year before I will delve a little bit more into the details of the financials of our organization. And before we then go into the strategy, summary, and an outlook, what you can expect from our company to deliver. And then we have, I guess, plenty of time for questions and provide some meaningful answers to that. With that, I hand over to Michael.
Thank you, Peter. Catena Media is an online lead generation company. We are one of the world's largest for the space we serve, which is primarily iGaming, and we also do a little bit in financial trading. We are the #1 in the fastest growing iGaming market at this point in North America. We also are very large in Europe and delve a little bit into some of the other continents that are starting to develop. We deliver valuable traffic to our operators via organic search and paid media using a blend of revenue shares, fixed fee, and CPAs. We have a very large network of sites across the globe, which are both countrywide sites, theater-wide, Europe and North America-wide, and global sites. We're about 400 people spread across multiple offices and also many remote. For example, our 70 or so North American people are all remote. We don't run an office, so we run a hybrid model. And we are listed on the Swedish NASDAQ, on the Stockholm NASDAQ as a mid-cap segment. Next slide, please. To quickly update anyone who is not aware of what an affiliate is, we run these websites that people find us when they do a search for, say, what is the current match betting odds for a team in the UK? Or how do I make a bet on this game? So they'll find our site. Our site will have information. It will have odds. It will have different types of sites have different information for different user searches. They will then, should they find the information they're looking for, they may click through one of the links of one of the operators we offer and go to the operator and then make that bet. If they make a deposit, typically, sometimes they have to make a bet, that operator will pay us for delivery of a customer. And one of 3 ways they will do that. Next slide, please. They will either have a revenue share deal with us where for the time that player is depositing and making bets with that operator, we are getting a share of that revenue stream. The other models are what's called CPA, cost per acquisition. That is where the operator pays us a one-time fee for the initial delivery of that player. We do this in markets where such as North America, where the operators are not really set up due to regulations or their own platforms in order to do a revenue share type deal. It also allows us to put virtual cash in our pocket so that we can reinvest in the growth of our organization without taking on additional debt. We also do, for a smaller portion, fixed fees. Fixed fees might be with operators who don't have a credit portfolio that says we should be doing rev share or CPA with them yet, or they may be customers who want to be higher up on the list of operators we represent on our sites, but the amount of traffic or volume that they currently have doesn't justify that. So they'll pay us a fixed fee, maybe even on top of a CPA or a rev share. Next slide, please. Catena Media, being a global operator and a member of the world, do focus also on sustainability. We do things with responsible gaming, since we recognize our major space is an entertainment form, and some people do have issues with that entertainment form. So we are an active participant in responsible gaming in groups and efforts around the world. We also work on our footprint. While we are a digital platform and have a small footprint, we want to have a positive footprint in the world in terms of how we act. We've done this historically through our offices in Malta, beach cleanups, and teams in North America doing things like helping homeless shelters in Vancouver, Canada. COVID changed a lot of how we work as groups because we were all remote. And so as we go into 2021, and myself being a relatively new CEO in the last few months, this is something I've asked the executives and the organization as a whole to figure out what is our true strategy going forward in this rather than a collection of efforts. So I won't say we have a strong strategy behind this. We have a collection of efforts, and the goal in 2021 is to turn this into an actual strategy to carry forward for the next 5, 10 plus years. Next slide, please. Talking about our highlights from Q1, which we did announce yesterday. The US has been the gem for the online gaming industry, sports betting industry for the last couple of years, and that continues. For Catena, it is our highlight as well. We saw 2 very large states launch sports betting and casino in Q1, Michigan and Virginia, on top of the already leading position we had in North America, bringing revenues to operators. So our iGaming business rose by 200% in North America, which became 55% of our total Q1 revenues. Those revenues being 40.7 million, which was a 53% increase year over year. Most of that is organic search revenue, which is high margin revenue. So the organic search was 38.4 of that 40.7, increasing 61% year on year. And our number of depositing customers, which is another metric we use to determine our success, also went up by 32%. In addition to the US, there's lots of positive momentum around the world. In Italy, where we do sports and casino, in Japan, where we do casino, and continuing global growth of one of our major brands, Ask Gamblers, which is a casino product heavy in Europe, but also now in Japan, going into the North American space, Latin America, etc. Europe, we continue on a transformation effort we announced at the end of Q4, where our European casino products were struggling in some markets. Germany, because of headwinds there from new regulations, which had seen a decline for us and many of the operators by 50% year on year, but also in other places where we needed to look on how do we globally align ourselves better between our sports and casino brands and prior acquisitions we had made. But we are having a solid focus on driving our global portfolio and making really good progress. Next slide, please. That progress has led to a massive increase in our adjusted EBITDA and very high margins. 25.1 million in adjusted EBITDA, which was a 94% increase year over year. And the margins increased by 29% to 62% for this quarter. Our operating cash flow is also exceptional, 20.8 million, increasing 85% year over year. We are a high cash generating business in what we do. And Peter will talk more to that later. We have a solid financial position, which has allowed us a strong foundation for further deleveraging and flexibility in terms of capital usage. We are looking at having tools in our toolbox, such as dividends, such as warrant and share buybacks, as well as potential M&A, which will be limited, but there will be some strategic in our growth, though more organic focus. We did just do our first M&A in a couple of years with the lineups.com, a US site that is sports betting that fit very well in with our portfolio, where we saw an opportunity for a second site in a national sports brand, in addition to the one that we had that was very strong. We always like to have a second one for contingencies, for changes in market dynamics, changes in search dynamics. The lineups met all of those. It also met our criteria for a very high margin product. This one, when folded in with us, is expected to be an EBITDA margin above 70%. So we have a strong foundation for continued profitable growth is what we believe we have going through the rest of this year and the coming years. I'll now turn it to Peter to talk more about those financials.
Thank you very much, Michael. And let's delve a little bit into the financials, updated with the first quarter 2021, and taking a look a little bit at the historic development of those financials. So here on that first slide, what we go through is our revenue development and one of our key performance indicators that Michael touched upon as well, the new depositing customers. So the revenue development over the last couple of quarters has been very pleasing in the sense of how it now developed into the first quarter of this year. As you see, during 2020 in comparison to 2019 was not an amazing uplift. And that is partly due to the COVID-19 pandemic impacts that we have seen on our sports segment. The sports segment has been roughly in the area of 30 to 35% of our total business. I will talk about that a little bit more on the next slide then. But there we have seen an impact, simply because sports events have been cancelled, sports leagues had certain delays, not all games maybe have been present. So there was an impact in addition to certain seasonality effects there, of course, as well. Casino, on the other hand side, has been a little bit pushed during the last year, and I will show some details on that. Nevertheless, in the overall picture, this first quarter here showed a very strong growth, both in comparison to the previous quarter, but also to the comparable quarter last year. Organic search revenue, even more so. Our paid revenue is a very conscious and intentional decision to spend less on that. What is paid revenue? That is simply a very given investment into what is called PPC, or pay per click, where you acquire traffic in order to then generate revenue. We have a strategic focus really on the organic part of revenue generation, that is the organic search revenue. New depositing customers, after really a declining trend, primarily on the sports segment during the last year, second and third quarter, which was really the result of a COVID-19 impact on the sports side of things. We have a continuous upwards trend since the third quarter of last year, with a all-time record really in new depositing customers, plus 32% as compared to the previous year. When we take a look at the share of revenue from a segmentation and the sourcing perspective, you will see that Catena Media has a very diversified setup in terms of in which segment we generate the revenue and we do the business in. And these segments are sports, casino, and financial trading, but also from a sourcing element. I will talk about that a little bit more. So roughly 60, a little bit above 60% of our revenues come from the casino segment. Traditionally, that has been always the strongest segment in our business. Sports, around a third of the total business, and financial trading, very tiny in that relation, has been between 5 and 6% up until now, the first quarter. We did a divestment of a business which was called Hammerstone in the fourth quarter. That was a news subscription service. And in relation to that, we had subscription revenues that we do not have now going forward. You see a spike in the second quarter 2020 on the share of casino. That was the effect of the beginning of the COVID-19 pandemic and the impacts that we've seen in sports. And at the same time, a surge really on casino and online casino and social casino demand, in particular in the US, where all the 900 plus land-based casinos and resorts have been closed during that point in time. We expect that that has actually a very positive impact to the future in terms of online penetration and online usage of gaming services generally. On the lower chart, when it comes to the sources segmentation, we have a pretty good mix between what is called a revenue share, so a new depositing customer that we have generated for our clients, the operators out there in the market, and a share of that lifetime revenue, so to say. That has always been a little bit above 40% and has been the dominant source in comparison to the other ones. Very closely followed, however, by what is called the CPA, and Michael talked about that, the cost per acquisition, a one-time fee. And then there are fixed fees where we have screen real estate, banners, and links that we offer to certain customers for a fixed fee. The first quarter was very different. As you see, the CPA share has been much, much larger. And that is entirely going back to the high revenue situation that we had in the US with additional 2 markets, Michigan and Virginia. Michigan, of which not only offered sports betting, but also casino. And the US market for us is a pure CPA market for the time being. So that explains a little bit the very different segmentation. It will stabilize again after this first quarter to a more segmentation of sourcing in line with previous quarters, as we expect. Revenue is one part, the cost part, and then of course our earnings is the other part. On the cost side, we have had a very good cost control, in particular during the last year. The beginning of COVID-19 essentially meant for us, as for many other companies and industries in general, to be extremely careful in the sense of where are we investing, what are we doing, because nobody really knew how long is this pandemic going to last. Nobody certainly was expecting that it's going to last for more than a year, and here we are in the situation. So we had a quite tight cost control, in addition to certain restructuring changes that we anyway did from the end of 2019 into the beginning of 2020. The three big items where we show in our external reporting the cost is our personnel expenses, and that is the largest part of our expenses. It is a people-driven business that we are doing when it comes to content generation on our websites, when it comes to search engine optimization and everything else around that. The second biggest part is other operating expenses. Those we kept particularly low because there is a lot of flexibility with variable cost elements that we can turn on or turn off depending on how much we would like to invest into our products, in additional product expenses, marketing expenses, and others. And the third element are direct costs. Direct costs are costs in relation, on the one hand, to our paid revenues, and on the other hand, to certain performance marketing measures that we take, in particularly in the sports segment in markets where we see tremendously high growth potential, but where we do not yet have the position as we have already in our other more mature and established markets. The cost ratio as a percentage of total revenues has been particularly low in this first quarter with 38%. So the total cost element in percent of revenue has been 38%. The comparable number was 52% in the previous year. Taking the revenues and the costs together, we arrive at an adjusted Ebitda. As Michael already elaborated on, we had a 25 million adjusted Ebitda that is double the amount of what we have seen in the fourth quarter of last year at a margin of 62%. The adjusted Ebitda has a certain seasonality in that, which clearly comes from the sports calendar and in particular on the peak that we have seen on Q2 2020 last year. The last 12-month indication line, the most top line here in the graph, indicates here that we are trending above 60 million in adjusted Ebitda. Out of adjusted Ebitda, or from Ebitda to operating profit, we have seen a 131% increase of operating profit, our EBIT, on a year-over-year basis, with a margin of 52%. That is an extremely strong development. There are certain elements like interest payments or the fair value adjustment in relation to our debt financing, existing bonds, those are, that make the difference then to our profit before the tax. Our EPS, our earnings per share, increased by 73% to 0.26 euros during this quarter. So we have a very strong financial performance, and that, of course, you see in our strong operating cash flow development as well. Our business and our business model is one that generates a lot of operating cash flow and is characterized by a very strong cash conversion. We had, for the entire year, last year, an operating cash flow of 49 million, so roughly 50 million, at an adjusted Ebitda of 52 million. We had a cash conversion of 98%. And you see here in the line, it is oscillating around 100%, slightly below on an average. Now in the first quarter, it was 89%, pretty much in line with the 90% that we've seen in the first quarter in the previous year. So very strong development. What happened because of the strong cash and cash position that we had, we voluntarily prepaid certain of our existing bonds and also repurchased some of them on the market. And at the end of the quarter, we had a cash position of a little bit above 37 million euros. That strong cash development enabled us, since the summer of last year, to significantly reduce our debt levels. What happened before or during the summer of last year was a refinancing that we did. We had an existing outstanding corporate bond at that point in time with a nominal value of 150 million euros. We repaid a third of that through the issuance of hybrid capital securities. These are equity instruments that come with an interest coupon as well on a quarterly basis, are treated as equity, and there are warrants out there in the market that can be exercised on a quarterly basis to convert into ordinary shares. So we have a built-in dilution of our share capital in that financing instrument. That enabled us to effectively decrease a net debt to adjusted Ebitda level, our leverage, from above 3, as you see here still in the first quarter last year, to below 2 immediately after this refinancing. And since then, with the operating cash flow development, to go below 1 at 0.64, where we have been now at the end of the first quarter. And with that, I hand back to Michael, who will wrap up with an outlook or a summary of our strategy and an outlook what you can expect for further growth in our company.
Thank you, Peter. Next slide, please. Just quickly, the market drivers in the world are all essentially lining up to be favorable for Catena Media. We're seeing, as Peter mentioned, a shift from land-based to online gaming, driven faster accelerating thanks to, it's a horrible way to put it, but COVID-19 changed the landscape of the online world, including online entertainment, which we are in the online entertainment area of gaming. Mobile technology has been further developing and will go even faster now coming out of COVID, we believe, and that is a good thing for a company like ourselves that is mobile first in our strategy. Regulation. Regulation is often viewed as a negative when countries are regulating for the industry of iGaming. We view it as a positive for Catena Media because we know how to work in regulated markets. We are regulated in all of the US states we are in, are the ones that require it. In many countries, we work with regulated operators. And the idea there is as regulations come, those make marketing rules that make it tougher for the operators, make it tougher for us too. But if we can help the operators in those markets, and they're often markets other affiliates can't play in, it's a good thing for us. The other things here are the increase in spend on digital marketing as more of the world gets access to the internet, all favorable for an online affiliate company. Next slide, please. Our strategic focuses are organic growth, as Peter and I have both mentioned prior. We are looking at geographical expansion of existing products. We have products like Ask Gamblers that we are taking globally. We have products as we look at the North American space that we say we are doing good products in Europe that we could potentially bring across. We always look at cost efficiency improvements. How can we bring technology to bear so that that human cost that Peter mentioned can be slowed or maintained anyways, as people are our largest costs. We are using AI content in certain markets and expanding that. These are the types of things where we can see cost efficiency improvements now that we have reached the size able to handle such technologies. And strategic M&A will be part of our strategy, but will not outpace by any means the organic growth, which is our future. When we talk about markets, we see markets in three ways. Growth markets, which are our highest priority. The US, our existing business there in the 11 states we're in that allow sports betting today and or casino betting. They're strong and important, as is Japan and Central and Southern Europe and Italy, for example. These are medium to high growth, and we expect good margins there, and we will continue to invest. Mature markets, UK, Sweden, Germany, going through these re-regulation or these regulation phases, changes happening, challenging right now, but have good potential, and we believe we can make great business there in the future and today by managing our business effectively. We will improve the margins there. We view Europe as a very important place and part of our business, and with the changing landscape, we will change and adapt to that. And then we have the incubation, which is the US, the new states. We would be foolish to ignore what the gaming industry considers the fastest growing market. The operators are there, so we will be there. Latin America and Asia we look at and we continue to dabble in for the day when those are regulated and ready for entry from operators that are regulated and Catena Media. We're doing some work in Japan today and a little bit in Latin America, but mostly these are future markets where we will nurse to fruition when they get there. Next slide, please. Speaking of the fastest growing area of the world for all iGaming, this is what we see is on the future horizon. Today, there are 65 million people in North America who have access, who are in states that have access to online sports betting. There's about 40 million coming from states that have approved regulations and are coming later this year or early next year, as well as Ontario in Canada, the largest province there, and all of the country of Canada is talking about regulating. Beyond that, about 100 million or so, there's another 100 million in just 4 states, New York, Florida, California, Texas. 2 of those are talking about regulating sports betting now and in process. And we are in all 4 of those states as Catena Media because we know it's a matter of when, not if, they're going to regulate. So our strategy is to be there first with managed low cost so that we can build sites and start to build up traffic and authority long before we can add operators to those sites and actually start doing regulated gaming there. Our business is to be there early. We're doing the same in these states that are larger and further out, because between them and what we refer to as the remnants, the small states, there's still another 100 million of the population. while timing may not be known, we believe it is all but inevitable that most of these states will launch some sort of sports betting. And then after that, there's still another wave of all of these couple 100 million people getting access to online casino. About 40 million have access today. Because of COVID and states depleting their coffers and not being able to tax small businesses to replenish them, they look to the sports betting first. When they look at states that only have sports betting, the states that have both sports and casino, those with the casino add lots more in tax dollars to those states. They're pushing for those in certain states already to add in on top of sports betting. Catena Media sees that as even a better business than sports due to the higher values of players. The operators will be there. We're already getting ready for that wave when and if it comes, or when I should say it comes, because it will come in the next 5-10 years, but it will be the next massive wave across North America, which will probably be the largest thing going on in the world for a while. So next slide, please. Our post-quarter activity, I'm very excited to add 2 new board members, 2 ladies, Esther and Austin, to our board, who come with a strong digital marketing background to add to our finance and AI and technology and gaming background of our current board members. We have announced that we are interested in a share buyback program and are going to have an EGM in July on top of the AGM we just had, since all conditions were not met to allow us to execute upon that. These are all conditional based on our current financing as well. We are in a process for refinancing. We announced that we're exploring refinancing options for our existing bond and with a bank term loan and a new bond loan. And our current trading update, which we announced as part of our Q1, we announced our April performance. In April, our organic revenue growth was 15%, 24% when we exclude Germany, which I spoke to the headwinds prior. And that's compared to average monthly revenue in Q2 2020, which Peter noted Q2 2020 was a high quarter for the year last year and was spiked because of online casino, because of the COVID pandemic closing many land-based operations around the world. So to be 15% above that, we consider a very good start to Q2. Next slide, please. To sum, we're seeing exceptional organic revenue growth in Q1, driven primarily by North American openings, but also by our global presence. Strong earnings and cash generation, open for growth-focused investments and financial flexibility that we spoke to in ways we can further our shareholder value. Lineups.com, one of the only recent acquisition we've done, and probably one of the few we'll do in coming days, but we will have strategic opportunities like this that we are in a position to take if they present themselves, or if we find them, I should say, and they strengthen our market-leading position in the US in this case. Strong start to the year, and as I just mentioned, to the second quarter as well. And organic revenue growth for 2021 should be well above the target. And our financial targets, as set by the company and the board, are profitable double-digit organic growth on a yearly basis, with North America being the core driver in the near term. And operate on a net interest-bearing debt adjusted EBITDA interval of 0 to 1.75, which we are well within, as Peter mentioned. That's our presentation. At this point, we'll open it up to questions, please.
Thank you, Michael. And my first question is, you have been active both in the US and Europe. How does behavior of operators and customers differ in US and Europe?
I'll take that one, Peter. So what we see in Europe versus the US for operators is somewhat of a different field of operators, because there were certain players in North America that are not in Europe who were there earlier because they were doing what's called daily fantasy sport, which is pre-regulation of real money gaming, something that was allowed. Many of the US players sort of grew up in a different understanding of how betting worked. So the operators in Europe coming across had to modify their platforms in something related to user behavior. And that user behavior we see in our sites as well, and how the searches work. The US markets are more nascent, so the players are often asking questions like, what does it mean to place this type of sports wagering bet? How do the returns work? How do I know where I win? Which operators are the ones that operate in my state? Whereas the mature European markets, it is often more about, for the player, about where can I maximize my return on my bet by which operator is offering the best for this game. So it's a matter of maturity, but it's also a matter of the starting point. North America starts later on in the cycle of the world. So the internet is more mature, mobile gaming is more mature. So the operators and the players are more mobile focused than maybe some of the historic European operators had been on a different point in their journey there.
Thanks. And my last question will be, I mean, historically, Catena Media has made a lot of acquisitions. How does this latest acquisition differ from the earlier acquisitions?
I think it differs in a couple of ways, but I think the most important is Catena Media is now, I would argue, a more mature organization. We learned a lot from those prior acquisitions, and doing a lot, as you put it, during a short period, you end up in the post-acquisition phase where you have to learn to integrate and how to operate and how to have a strategy. It took us quite some time to get off all sorts of earnouts and other things, which allowed us to have actually full control of those products. That's where we now focus on organic and building with those teams that we now have in place that are all part of Catena Media. So going into this new acquisition, there was a lot more diligence process involved, both internal, and we used external firms so that we really knew under the hood what we were buying and how it would fit in with our strategy. And the strategy was what drove the acquisition versus finding an acquisition and then making a strategy behind it, which might have been some of our historic period before any of myself, Peter, or any of our executive or board members were on board. So I think we're becoming more mature. We are also looking at what folds into our current business as opposed to, in this case, looking for new strategic openings with acquisitions, which were how we get footholds in markets. Now we have footholds in most markets, North America, Europe, small one in Latin America, which is all it needs at this point, and Asia. So the organic is a better investment for us if we can be there early. So I think how we look at M&A has changed dramatically, and how we do M&A has definitely changed.
Okay, cool. And I'll continue a couple of more questions. And my next question will be, I mean, I remember when the United States opened their betting markets, Catena were the first company there. How has the competition developed from during the last couple of years?
Certainly. As you would expect in a developing market, more competition appears. And there's competition on a couple of levels. There's the local competitors who are what I might refer to as mom and pops, who are small startups that have seen an opportunity for affiliation. They have challenges competing in terms of the regulatory hurdles that are there. But the companies like Lineups, which were essentially got dropped.
Well, Peter, maybe you want to...
Well, I can chip in, yes. I think the sentence that Michael wanted to end is Lineups essentially has been, of course, a competitor to ours. We have seen Lineups competing with us on search key terms in various states, where we have been maybe in the top 3 positions, they have been behind us. And in some other states where they have been in top positions, we have been behind them. So there was obviously a very good strategic fit. There are other competitors out there in the market. There are other international competitors that buy themselves or buy themselves bigger in the market. So it's the usual competitive development that we would have expected in such a growing market as such.
Okay. And Peter, thank you for your time for coming here to Penser Bank. And Michael, thank you for dialing in from the US. And thank you everyone for listening to Catena Media here at Erik Penser Bank.
Thank you very much. Our pleasure.
Thanks.